So the recession is going to be worse than analysts expect, and the bottom is going to be lower than analysts expect. It could go down, easily go down 30%.
Is the financial world on the brink? Are your savings safe? Jim Rickards, the best-selling author who predicted the 2008 crash, is dropping a bombshell.
So the recession is going to be worse than analysts expect, and the bottom is going to be lower than analysts expect. It could go down, easily go down 30%.
Banks are collapsing, a major crisis is looming. But there's one asset he says can weather the storm. You might already own it. This isn't a drill, folks. Stay tuned, because you're about to dive into the truth about the coming crash and the one thing you need to hold on to.
This is going to be part of what throws the economy into severe recession. They're raising rates and inflation's coming down. But what they don't know is, are interest rates coming down because they're raising rates, or have they already hit the terminal rate and it's coming down on its own and they just don't know it?
We are all aware of a recession happening, and its effects are noticeable. This leads to more businesses closing, people losing their jobs, and a decrease in the overall economic output. Even though we hope for better times, it's important to recognize that recessions are a natural part of the business cycle. The duration of recessions varies. The United States has faced multiple recessions in the last 2 decades, such as in 2000, 2007, and 2020.
The signs were everywhere, but now it's official. We are in a recession. The research group that makes that determination made it today and said the recession actually started a year ago. But the question now, when will it end?
This indicates a pattern where the cycle seems to repeat approximately every 7 years. However, from 2020 to 2023, it hasn't been 7 years yet. So, why are we currently experiencing a recession? The answer lies in the unpredictable nature of the financial world. There have been instances of consecutive recessions before, notably in 1980 and 1981.
Recession is going to be worse than analysts expect, and the bottom is going to be lower than analysts expect. It could go down, easily go down 30%.
At least there was a 2-year gap between 2020 and 2023, but unfortunately, the recession in 2023 is accompanied by a financial crisis.
And it wouldn't shock me if it was down 50%. You're looking at, S&P, 2,000, 2,100, something like that.
The financial crisis is currently developing, causing widespread concern. If it strikes, it will have a severe impact, creating a truly dark day for both America and the world. It's important to understand that each financial crisis carries its own level of impact, some resulting in significant losses, while others may not be as substantial. However, according to Jim Rickards, predicting the scale of a crisis and how quickly it will resolve requires assistance.
Things I mentioned earlier: inflation, deflation, job creation, economic growth, capacity, what's going on in Europe, etc. Those will all be no's, and there would be influences.
Occasionally, a financial crisis can coincide with a recession, and when this occurs, it becomes a genuine disaster. We have only witnessed one such instance in history: the subprime mortgage crisis that persisted from 2007 to 2008.
You can imagine the American economy is an economic train moving down a track that has no ending, and it picks up.
The expansion of mortgage credit contributed to the crisis, providing easy access to loans and mortgages for many. This error led to the bursting of the housing bubble in the US, causing a significant decline in home prices. As a consequence of this crisis, numerous individuals experienced the loss of their homes, savings, and jobs. However, its effects were not limited to America alone, as the United States is the hub of global trade, causing the entire world to feel the repercussions of the crisis.
We've been talking about recession, inflation, deflation, but the one thing we haven't spoken about yet, and you kind of just referred to it, is there a global liquidity crisis coming?
Worldwide, industrial production faced a collapse, credit markets were frozen, and commodity prices experienced a decline. The 2008 crisis resulted in a global economic growth loss exceeding $2 trillion. Jim Rickards suggests that the only other instance resembling this situation was during the Great Depression between 1931 and 1933. That period witnessed numerous bank failures, consecutive currency devaluations, and a general cessation of world trade. Interestingly, history might be on the verge of repeating itself. Consider the possibility of 2023 bringing about a collision of financial crisis and recession similar to the one in 2007 to 2008. This isn't mere speculation. Financial experts like Jim Rickards have already pointed out the emerging signs. What are these signs, you may wonder? Firstly, there's a decline in world trade, as predicted by the World Trade Organization for 2023. Secondly, daily reductions in industrial output coincide with a growing unemployment rate. Moreover, the current highest interest rates in American history, peaking at a 15-year high, aim to alleviate inflation. However, the inflated prices of goods and services persistently erode salaries and wages.
Well, we can come back to that. But, okay, so the inflation sort of came on the scene in mid-2021, in the summer 2021. By the fall, it was very high. And this is when Jay Powell was saying transitory, transitory, transitory. By November 2021, he threw in the towel. He said, okay, time to retire the word transitory.
If you remain skeptical about the ongoing recession and financial crisis, observe the current state of our banks in America.
And then they started hiking rates in March. On March 1st, the policy rate, the Fed funds target rate, was 0. Today it's 4.25%. It's going to go up another 50 basis points on December 14th.
In just 1 month, 5 major banks have faced setbacks. Silvergate Bank, valued at over $5 billion in 2022, declared bankruptcy on March 8, 2023. Following suit is Silicon Valley Bank, which, due to poor management causing a financial crisis, was taken over by the FD on March 10th. The third casualty in March was Signature Bank, officially taken over by the FDIC on March 12th. Signature Bank's collapse resulted from a bank run, triggered by depositors panicking to withdraw their funds after the failure of Silicon Valley Bank. First Republic Bank also makes the list of failed financial institutions. Rescued from a $30 billion liquidity crisis by 11 banks on March 16th after experiencing a loss of approximately $70 billion in deposits. Lastly, Credit Suisse, one of the world's largest banks and the second largest in Switzerland, collapsed in March 2023 and had to be acquired by a rival bank, UBS, for $3 billion. All these 5 bank failures occurred within a single month. Jim Rickards states that the collective losses suffered by credit and stockholders of these financial institutions amount to over $200 billion, a substantial sum. The recent failures of these banks have sent a clear signal to the public that there's a significant issue in the financial system. Currently, people are becoming increasingly anxious, and in an effort to quell this panic and reassure the public about the safety of their money, the FDIC is taking unconventional measures to regulate these banks.
3 options to reform its deposit insurance system following several recent bank failures. Among the options disclosed in a report earlier this hour, the FDIC's preferred choice.
Let me explain how. Typically, the FDIC's maximum deposit insurance limit is $250,000. However, in the aftermath of the March 2023 bank failures, the FDIC is now guaranteeing all Silicon Valley Bank and Signature Bank depositors an insurance deposit of over $200 billion. This is an unprecedented move and, as anticipated by Jim Rickards, may deplete the FDIC insurance fund. While it may seem commendable now, at the end of the day, the burden is likely to fall back on consumers and ordinary individuals at the bottom of the economic hierarchy. Continuing on the matter, the Federal Reserve is also offering to provide additional loans to member banks.
The FDIC and Sheila Bair and others guaranteed every bank deposit in America. They didn't have to do that. We had a $250,000 insurance limit.
They plan to make this extra funding available through the Bank Term Funding Program, BTFP. According to Jim, the total cash volume for these loans could surpass $1 trillion. These actions have significantly unsettled the U.S. banking system, causing widespread confusion, especially among depositors. The question arises, are they introducing a new policy, or are these unconventional moves a response to the challenges faced by a few top players affected by the calamities of these banks?
But some, small business might have $1 million in the bank, so they were pulling the money out of the bank. So Bernanke said, forget that. We're guaranteeing, regardless
Guarantee
of size,
everything.
guaranteeing everything.
This was in 08, right?
08, correct.
I remember I was in London and I was concerned about my deposits.
As the US government seemingly overlooks the fact that unrealized losses in US bank portfolios have surpassed $700 billion, the banking system is at risk of collapse if, amid these changes, the government continues providing cash to withdrawing depositors from its reserves. While their intention is likely to reassure the public about the safety of the banking system, the question remains, is it true? Have they genuinely convinced us that everything is well? And most importantly, is the crisis truly over? The answer is no. The panic is just beginning. Recall the 2008 financial crisis we discussed earlier, which bears similarities to the situation in 2023. That crisis commenced in the spring of 2007, triggered by HSBC's announcement that mortgage losses had exceeded expectations, sparking a significant panic and setting off a chain of events leading to the financial crisis.
Are we in a debt crisis or are we headed for one? We are in my opinion, we are at the beginning of a very classic late big cycle debt crisis.
Some notable events during that period include the failures of financial institutions like Bear Stearns in March 2008, Fannie Mae and Freddie Mac in June 2008, the closure of Associate General Money Market Fund, and several other institutions. However, it reached a critical stage in September 2008 when the Lehman Brothers, considered top players at the time, filed for bankruptcy. This illustrates the progression of such crises. Drawing parallels to the 2008 scenario, it developed steadily over a year and 6 months, whereas our current crisis, only 1 month old, has already resulted in the downfall of 5 banks. But here's the alarming part. It could deteriorate rapidly. Jim Rickards has concluded that our current technology could accelerate the unfolding crisis. Here's his reasoning. Technology has streamlined processes to such an extent that if there's a bank run, it could happen in the blink of an eye. Consider this scenario. You hear that Silvergate Bank has collapsed, and one of their partner banks, where you have your account, is on the verge of failing. What do? Rush to the bank to close your account? Certainly not. Your immediate response would be to transfer all your funds to a secure account, a task easily accomplished through a wire transfer on your phone in a matter of seconds. Whether the amount is $1 or $1 million, the process is as simple as clicking a few buttons. As you can see, unlike the past when people had to queue at the bank for withdrawals, things have changed. Customers can now make a run on banks faster than ever. Jim Rickards also posits that the panic will escalate more rapidly this time because people have witnessed a similar situation unfold before as it did in 2008. Savvy individuals have already withdrawn their money and invested it in assets. There is diminishing confidence that the government can restore normalcy to the situation. And rightly so, because at present, the crisis is shifting from the banking system to the dollar itself. We are well aware that the almighty dollar serves as the world's reserve currency. So, what happens when this reserve currency falters? A global financial tempest. Precisely. Keep an eye on the news, and you'll observe numerous countries attempting to distance themselves from the dollar. Currently, China is advocating for the yuan as an alternative for global trade.
Asia's 2 biggest economies, Japan and China, are to start trading their currencies directly from the start of June. Previously, they'd set exchange rates through relative dollar values. The direct yen-yuan trade in Tokyo and Shanghai.
Russia is already engaging in international trade using the Chinese yuan. Saudi Arabia, Brazil, and Iran have all abandoned the dollar in favor of trading with the Chinese yuan. Is it possible that other countries are gradually losing confidence in the American government? Unfortunately, it seems so. Bankers are losing faith in the federal government, and nations are running out of patience as well. What will be the ultimate outcome? Banks will collapse, and the dollar will follow suit. Anticipate witnessing more bank failures in the upcoming months. Jim believes that the U.S. Treasury will soon deplete its cash reserves and need to borrow more. Considering these projections, it's evident that the current financial panic is just commencing and is expected to intensify. The impact will reverberate through American banks, extending beyond to a looming debt problem. As we've outlined thus far, there is limited recourse for the government in this situation. If anything, their desperate attempts to curb the panic may only hasten the decline of the financial system. So, with all this in mind, what should be your course of action? How do you respond to the panic? And what measures can you take to safeguard yourself from the impending crisis? While we may not be able to prevent what's coming, we can certainly adopt steps to preserve wealth. According to Jim Rickards, the first crucial step in self-preservation is acquiring gold. Gold is the key asset that will help you weather the storm, and even the government recognizes this. In a recent tweet, Jim Rickards revealed that members of the U.S. Congress introduced the Gold Standard Restoration Act.
Look, if you're in gold to get rich quick, I would pick a different asset class. Buy some Bitcoin. You might lose all your money, but maybe you'll make 10 times. So,
proposing to anchor the U.S. dollar to a specified weight of gold. This is a significant indicator and a call to action for you. If you genuinely aim to secure yourself amidst the approaching storm, invest in gold. You can opt for gold bullion or explore mutual funds and ETFs. However, Jim Rickards strongly advocates for gold bullion as the preferred method. For clarification, gold bullion refers to gold bars or coins, and you can obtain them through an online dealer or a local collector.